What's happening, everybody? It's your boy Kreative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all today. We're going to be dropping another episode in our KreativeU series. And today we're going to be talking about the difference between stocks and options, right? I know this is something that we should have covered before, right? But little me, I made assumptions that we understood the difference. And sometimes I make a little errors, right? So I think it's best for us to be able to go ahead and understand the difference between the two. So if you haven't already, I need you to go ahead and like and subscribe. So let's go ahead and jump into this. Right. So we're going to be breaking this down into lessons, right? And then after each lesson, we're going to have just a check for understanding quiz, right? So I need you to pay attention and go ahead and drop your answers in the quiz in the comments. So the first lesson is going to break down what is a stock. Now, the word bank that we're going to have is stock. And what is a stock? A stock is a tiny piece of ownership in a company. We own one share. It's like we're owning one slice of pizza within that company, right? So one share is one unit of a stock. It's like one slice of a pizza pie. Equity is just a fancy word for ownership. So your stock equals equity in the company. Just if you only have one, you still have equity in the company, right? And dividend is free money that some companies pay you just for owning the stock. It's like a thank you bonus, right? And then we have market cap. Market cap is the total value of all shares. If all the pizza has eight slices, if the pizza has eight slices at $2 each, the market cap is $16, right? So we understand that. So the market cap equals the total value of all the shares. So if we're looking at a pizza pie, right? And within that pizza pie, we have eight different slices within that pizza pie, right? And then each one of those slices costs $2. Our market cap for that pizza is $16, right? That's quite of an expensive pizza, if I'm gonna say so myself. All right. So the definition: a stock is a tiny piece of ownership in a company. When you buy a share of Apple, you literally own a microscopic slice of Apple, right? So think of it like a pizza. The whole pizza is the company, and each slice is a share. Buy one slice, you own that piece of you own the piece of the pizza. So memory trick is a stock equals you own a piece of the company, like owning a pizza slice. What owning a stock gives you is ownership. You are own a part of the company. You also have voting rights, right? You can vote on the company's decision. You also, if the company pays, is dividends. Some company pays you just for holding the stock. There's no expiration. You own it forever until you sell it. And there's unlimited upside. You can hold the stock forever. In theory, right? There are some stocks that do go belly up, right, that just go bankrupt and they just sit there 0.01 cents, right? I've had that happen to me a couple times where I just figure, oh, I'll just hold it, right? Then you end up being able to like, damn, this is worth nothing. But you can hold it forever, right? The biggest difference between a stock and an option, right, is that you have that unlimited upside in theory, right? And you can hold it forever and there's no expiration. So let's take a look at a live stock. We're going to look at the S&P 500. The S&P 500 is the top 500 companies within the New York Stock Exchange, right? So when we're looking at the S&P 500, ideally we can be able to understand how the overall market is doing, right? So it's the top 500 companies. So 500 companies on average is doing well. The S&P 500 is doing well. Then overall the market is doing well. Is doing well. So the current price is 683. Today's change is $1.25, right? So the current 52-week high is 697.84. The current 52-week low is 481.80. That's quite a dip, right? Today's volume is about 40 million, and what it costs to own 100 shares of SPY. So you're going to take 100 shares times 683. It costs 68K or $68,305 to be exact to own 100 shares of SPY. So you would own 68,000 worth of SPY. If SPY goes up 1%, you make $683. If SPY goes down 1%, you also lose that amount as well, right? So we understand what we're going to be talking about. Let's go ahead and jump into our quiz. So when we buy a stock, what do you own? Is it a contract that you can buy later? Is it a piece of a company? I think I heard that before. It's the right to vote only, It's not. It's a right to vote, but it's not only. So just by process of elimination, we know when we buy a stock, we own the piece of the company. Beautiful. Can stocks expire? Yes, after 1 year. Don't think so. Yes, after the company's fiscal year. That'll be crazy. No, you can hold it forever. So just by process of elimination, we can go ahead and get our answer. So to own 100 shares of a stock that costs $500, how much money would we need? Just $500? That's crazy. To own 100 shares of a stock, to own 100 shares of a company, that's crazy. Is it $5,000? You forgot a zero. I think it's $50,000, right? Because we're going to do 100 times 500, and we're going to do $50,000. You ever seen that trick? You put the five, then you put the amount of zeros that you had. So right, so there's 4 zeros, right? Then we have the five, so that's 50,000. So that's why I said you forgot a zero. All right, beautiful. Why 100 shares? You want to take 100 shares, multiply it by the 500, and it's 50,000 to be able to have full capital. And it requires full capital to own. So we understand that is a stock. So now let's go ahead and jump into what is an option, right? So an option is a contract that gives us the right but not the obligation to buy or sell a stock later. More on this buying and selling business in a bit. A contract is one agreement, is the agreement, right? One contract controls 100 shares. The premium is the price you pay for that option. It's like the movie ticket you pay up front, right? And you can decide if you want to go to the movies or not. The strike price is the locked in price when you can buy or sell your reservation price, right? For lack of better words, think about it that way. The expiration is going to be the deadline. After this date, your option disappears, right? Poof, it's gone. A call is when we're bullish on the market. This is we're going to bet that the stock is going to go up. This gives us the right to buy at the strike price, right? So we're mixing in a few. And then our put is we're bearish on the market. We're betting that the stock is going to go down. This is our right to sell at the strike price, right? So let's jump into our definition. A definition is going to be an option contract is a contract that gives us the right but not the obligation to buy or sell a stock at a specific price by a specific date. So let's just break this down real quick. That contract, right? What is that contract? That contract is an option. What does that contract gives us the right to do? It gives us the right but not the obligation, right? So I can do it if I'm thinking about it, but I don't necessarily don't have to. I could just take my buckets and go ahead and leave, right? So it's the right but not the obligation to buy. If we're buying an option contract, and that's going to be a call that we're bullish on the market. If we're selling an option contract, that's going to be a put, we're bearish on the market, right? That specific price is going to be the price that we think that that option contract is going to go to. The specific date is going to be the expiration date. So think of it like a movie ticket. When you pay for the ticket, that's the premium. That gives you the right to see the movie, but you don't have to go. If you don't show up, you just lose the ticket price, which is going to be the premium. So a memory trick here is an option equals a ticket that gives you the right but not the obligation to go. So there's two different types of options. We have a call option. This is the right to buy at the strike price. You want the stock to go up. You are bullish on the market. So call it up, right? Price is going up. So another way to be able to remember it. And a put is a right to sell at the strike price. You want the stock to go down. Put it down. The price is going down. And you're bearish on the market. So another key terms to be able to understand is the strike price is the price locked into the contract. This is where you want the price to go. The premium is what you paid for the option contract. That is the ticket cost in our movie analogy. Then we have the expiration. The expiration is where the option dies, right? That's where the show is over. And then a contract equals one option contract, right? And one option contract equals 100 shares. So here's a live example of the pulling in SPY. Now remember, SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. So we're seeing that the stock price is 681.92, right? And then for options that are expiring today. So these are 0 DTE options. These are option contracts that expire the same day, right? So we're looking at the money option contracts. We're looking in order to buy 681 in order to control 100 shares. Now, the difference between a bid and an ask, right? How I like to think about it. Now, when you go over somebody's house, normally what do, right? Some people just like to show up, be like, yo, I'm outside. Please ask, right? You're going to see where I'm going here. So when you go in over somebody's house, you normally ask, right, to go over their house, like, yo, I'm coming over. Are you home? All right, bet I'll be there, right? Now, when you want to get into the market, you have to ask to get into the market, right? So you're going to pay the ask price to get into the market, right? Now, when you leaving the market, when you want to get out of the market, you're going to get the bid price. So to understand, when you want to get into the market, what are you going to be paying? You're going to be paying the ask price. And when you want to get out of the market, you're going to be paying the bid price. Now, in order for us to understand, in order to control this 681 strike price, and this is where we think that the price may go to, right? We're going to be paying the ask price. I also had another thing, just real quick. Y'all ever had that teacher, right, that will be like, don't ask me, ask me, right? Don't ask me, ask me. If you know, you know. Let's keep going. The AX, right? Because sometimes we can be able to like ask, don't ask. But all right, never mind. If you get it, you get it. Let me keep going. All right. So in order for us to be able to figure out, okay, how much is it in order for us to control this 681 strike, right? We're going to take our 210. So 210, and for every one option contract, there's what? 100 shares, right? So we're going to take the 210 multiplied by 100. So it's going to be $210 in order for us to control this 681 strike, right? And that's still 100 shares. So we have leverage, right? So we control 100 shares. That would have cost us 68K, but in buying options, right, we can buy that same 100 shares for 210 bucks, right? And we're controlling 68K, right? If we want to go down to 682, if we want to bet that, okay, I think that the market is going to go to 682, it's going to cost me 151, excuse me. If we want to bet that a little bit deeper, that the market is going to go to 683, it's going to cost me $103, right? And I'm still controlling the same amount. So the power of options is to control 100 shares. So for a stock, in order to control 100 shares of stocks, right, I needed 68K just to control that same 100 shares. Now for an option, I buy one contract. To control that same 100 shares, it costs me $151, right? Same exposure, but 452 less capital, right? So, but options expire worthless when stocks don't. So that's just the trade-off, right? So that's why I love trading options, right? It gives me control, allows me to be able to take advantage of leverage and the volatility of the market, right? So you just don't have to be bearish. You can also be bullish as well. So we understand. All right, let's go ahead and jump into our quiz. What does an option give you, right? An ownership of a company? I wish. Is it the right but not the obligation to buy or sell? That sounds familiar. Or is it guaranteed profits? I wouldn't be mad if you said that. So what do you think? Is it A, B, or C? What does and what an option gives you what? Right? And we're going to go ahead and say B. All right. Why? Option gives us the right but not the obligation. You can let them expire if you want. There's strategies where you want them to go strategy, like a will strategy. Sometimes you want, and that's selling premium or being able to sell options and collecting premium, right? So you want them to be able to expire worthless, but more on that a bit later. Let's just keep it super simple, right? So we understand what an option is. It is the right but not the obligation in order to buy or sell a stock. So one option contract, how many shares do we control? So if I'm buying one option contract, how many shares do I control? Is it one share? That's crazy. Is it 10 shares? You weren't listening. Or is it C, 100 shares? That sounds a little bit familiar. Not V, C. It's right next to it. I just mistakenly typed it. This is for the U.S. standard markets. So we buy a call option, right? What do you want the stock to do, right? Remember, call it up, right? If you're calling something up, right? If the market is going up, then we're bullish on the market. What do bulls have to be able to really ingratiate this? Bulls have horns. What do those horns do? Those horns point up, right? So if you're calling something up, you're bullish on the market. You want the stock to go up, right? So that is B. All right, beautiful. So let's go ahead and go to our next lesson and cost and leverage, right? So we can truly understand this, the money comparison. So our word bank, these are terms that we're going to need to know. Leverage is going to be control more with less money. So we just talked about that before, right? Being able to invest in options provides us with a little bit more leverage, right? Being able to control more with less money. It's like a crowbar to lift heavy things. Capital is going to be our money, the cash you need in order to trade. Exposure is going to be how much you're exposed to price movements. The more exposure equals a bigger swing, right? Either a bullish or bearish swing, right? Either a swing going in the for you where you're making money, or a swing going against you, because there's no guarantees in the market. Margin is going to be borrowed money from your broker. This is extremely dangerous if it's misused, fam. Like, I'm no, yeah, there's always horror stories. We get a margin call. You basically, all right, bet. I think that this option is going to go through the roof, right? It's because it's a moonshot. So let me go borrow money from my broker. But oh shit, it just didn't work out for me, right? What happens is going to be a margin call. Your broker was like, yo, run me that, right? You thought, but run me that. I'm going to need that, right? So this is extremely dangerous, right? That's why whenever you're exposed to the market, I would recommend that you use your own capital, right? The cash you're going to need to trade. But again, this is not investment advice. If you do seek investment advice, please make sure you talk to a certified financial planner, those that are licensed in order to assist you. This is merely educational. Let's keep going. I feel like at this point, I could just do that by myself. Let's keep going. Control. With options, you control 100 shares without owning it, right? A little bit more leverage. So leverage means controlling more with less money, right? So with options, it gives you massive leverage. You can control $68,000 worth of stock with just 400 bucks, right? But leverage is also a double-edged sword, right? So memory trick is a crowbar for your money, lifts more, but it also could snap back, right? So you can be able to lift what you need, but that shit could come right back to your face if you don't do it well, right? So for a stock, in order to control 100 shares, it's going to be $68,102. But for that same 100 shares, when it comes to an option, it's going to be $234, right? So the leverage is 291x. You control that same $600,000 when it comes to that option, that stock, right? But it just costs you $234. So if SPY goes up 2%, the stock profits $1,362.04, but the option is going to profit $947, right? If I didn't, were you going to show you this? Even though the stock made a little bit more money cash wise, right? Our returns were sicker because our cost basis. How much did it take and cost me to get into that thing, right? So if it's going to cost me $234 to get in, but I can pop 947, I think I'm going to go this route without costing me. Yes, you made more money. You made 1,300 bucks, but bruv, how much did it cost you? Right? So you got to be able to take those things into consideration. So you got to understand the difference as well, right? Options can go down, stock prices can go down, right? So if it goes down, you're losing that same $1,300, right? So the leverage cuts both ways. You got to be able to understand that. It's just not always the upside. There's always the possibility of the downside. So the leverage truth, options amplify our gains as well as our losses. You can make 50% in one day, or the caveat, you can lose that 50% in the same day as well. So leverage is powerful, but it's also dangerous if not treated well, right? That Spider-Man movie, if I could quote that line right now, with great power comes great responsibility, right? Leverage is that power, but responsibility, if you don't play with it, it will be dangerous. So never bet more than you are afford to lose. So let's go ahead and jump into our quiz. So if we buy an option, it gives you 20K leverage. What does that mean? You can profit 20x, profit guaranteed. There's no guarantees in the market, so we can go ahead and chip that away. You control $20 for every $1 invested. That sounds kind of interesting. You could only lose $20 max. Bruv, I wish. Right? So just by process of elimination, we have our answer. Why? Leverage 20x equals control of $20,000 with just 1,000. Gains and losses are amplified. So a stock costs $50,000. An option costs $500. If the stock goes up 2%, the option goes up 40%. Why? Right? We just talked about it. Options are magic. That's crazy. Harry Potter and if there were magic, what house? Do you think option would be a Ravenclaw? Do you think options would be Slytherin? Do you think options would be Hogwarts? Or do you think options would be Hufflepuff, right? What house do you think options would be in if options were magic? And they're not, fam. But if options were magic, what house do you think it would be in? That's interesting. I think let's put that out there for the crowd and see what y'all say. So 100K leverage, right, amplifies the percentage return. The market is rigged. So just by process of elimination, fam, we already know the answer. Why? We invested 100 times less, so your returns is 100 times higher. That is leverage. All right, leverage is dangerous because it only works in a bull market. That's wild. And what is a bull market? A bull market is when we think that the market is going to do what? Shoot up, right? But we also got to understand that that doesn't work, fam. So just so we can knock that out. It amplifies the losses just as much as the gains. So that sounds interesting. The government tax it more. All right. Okay. So we're going to do B, right? So just by process of elimination. So let's go ahead and jump into our next lesson. Next lesson is going to be our risk profile, right? Who lives where, and I'm not going to say that, or who investigates, right? Or whatever. So our word bank is going to be our max loss. This is the most that you can lose. Stocks can go to zero, right? And options is going to be the premium paid. So options has a what? A controlled loss, right? Whereas stocks, right, it's infinite, right? The infinite is like you could go down to zero, fam. Yes, you can hold that thing forever, right? But it could also go down to zero. Whereas options is controlled. You only lose what you paid, which is that premium. So time decay, options lose value every day or sometimes every hour, depending on the date of expiration. Now, remember, every day is going to be something that's a little bit more than what we trade. I normally trade 0 DTE option contracts that expire the same day. So they're losing every hour, if not every second, fam, when it comes to time decay. It's like an ice cream melting in the sun when you're holding an option. Unlimited upside, no ceiling on the profits, but there are some option let's keep going. Stocks can go up forever, theoretically, right? Uh, excuse me, I just had to cough there. I didn't want to cough in your ear. Expiration risk, options can expire worthless. Spock, be what? Stocks can never expire. Then a type of risk that we have to understand is the assignment risk. This is the option sellers must buy or sell the stock. Only for sellers, not buyers. So only for individuals that are what? Buying puts, but they're selling it. So you gotta understand. You can also sell calls too, right? But that's a conversation for another day. So let's just keep it that way. So an assignment risk is option sellers must buy or sell the stock, right? This is only for the sellers, not the buyers. So risk comparison. So stocks and options have very different risk profiles. Stocks are like a marathon, slow and steady wins the race, right? Whereas an option is like a sprint with a ticking bomb fast, but time always is against you. So memory trick is a stock is a marathon and then an option is a sprint. So stock risk profile is that time is on your side. You don't have expiration. You can recover from your losses if you just wait, if you're a bit more patient. Dividends while you wait, depending on if it's a dividend paying stock. There's no theta decay eating your profits, right? And what is theta decay? That is time value loss. Basically, if you're holding an option, it's like holding an ice cream cone, right? If you don't get your profits fast enough, the thing is going to melt in your hand. Max loss equals 100%. Stock can go to zero, right? Requires larger capital. And then we're going to have lower percentage gains because of our upfront capital requirement. So then option risk profile is going to be max loss is going to be the premium you paid. So we have a defined risk, right? So that their defined risk is going to be our premium paid, and our premium paid is going to be that one option contract, and that one option contract is going to be 100 shares, and it has 100 shares that gives us the what? The right and or but not the obligation in order to buy or sell that option, that stock, right? Capital investment is going to be smaller. We have huge percentage gains that are possible. Can profit from volatility itself depending on how you play the market. One thing to keep in mind though is that time decay, right? Theta is going to eat at you. Remember that ice cream cone. Whenever you buy an option, you are literally holding an ice cream cone, fam. Not literally, but figuratively holding an ice cream cone, right? If you don't profit fast enough, or if you don't move how you're supposed to move, right, it is melting in your hand every single day. But there are some places where like you can theta gang it, right? You can be able to, like, you want high theta because if you're selling options, right, you want to be able to make as much premium as possible, right? So that's when sometimes theta works for you, not against you. But primarily, majority of the time, we're buying, right? And if we're buying, theta is working against us every single day, if not every single minute. It can't expire 100% worthless, right? You must must be right about the direction and the timing, right? So we got to pick which way the market is going, and we have to be able to time it up correctly, right? So we have to pick, all right, the market is bearish and I think it's going to last for 10 minutes, right? Or the market is bullish and I think it's going to last for 1 week, right? So we have to be right about the direction and the timing. It's a little bit more complex to understand, but not really if you just spend a little bit more time with it and understanding what it does, how it works, and how you can profit from it, right? So get to the basics of it. You get to the basics of it, you're Guapater, fam. So here's our time decay problem, right? Options are like an ice cream cone on a hot day. Every day that passes, some of your option value melts away. That's called theta decay. Day one, our option starts at $500. By day 7, $100 is melted away, right? By day 14, $200 is melted away, right? By day 21, $300 is melted away. And if you haven't done anything with it, you're just holding the cone, fam. The clock is always ticking against us when it comes to option buyers. So here's a side-by-side comparison when it comes to the risk profile. So our max loss when it comes to stocks could be 100%, right? It could go down to 0. Whereas our max loss when it comes to options is a defined risk. It's going to be 100% of the premium paid. Our time pressure, right? It's really none for stocks. You can hold that thing forever and just wait for it to bounce. And then option is going to be high because it expires. Recovery, yes, if we wait. No, if it's expired, right? But I can also say yes, recovery is possible, but it's just also depending on that timing, bruv. I think the direction you could almost kind of like, it could work for you, like, right, you could be wrong on the timing, right? Excuse me, wrong on the direction, but at that timing, bruv, that'll eat you up because you can make it up, but it's all depending on like how much is your like paying, like you going in for $50, right? Never mind, let's keep going. uh Daily decay is going to be none when it comes to stocks, but options, yes. Remember that ice cream cone. We must be right on the direction when it comes to stock, but for the options, it's the direction and timing. Complexity, simple, but it's all depending. You can get a little bit more complex when it comes to the stocks. And then options is Greeks, but don't let the Greeks scare you, fam. So what is theta decay? Theta decay is when the option is gaining value over time. I wish, bruv. Option losing value every single day just from the time passing by. It is a Greek restaurant. I think that is a dope name for a Greek restaurant. Theta decay? Tight shit. Yeah. All right. Let's go ahead and jump into our next question. Your option expires worthless. What is your loss? Unlimited. Doesn't sound right. It's going to be the premium you paid. That sounds interesting. Or nothing. Options are free. I wouldn't be mad if you said that. All right, so it is going to be B. Why? Because max loss option buyers equals the premium paid. That is an actual benefit because what? It is a defined risk. So the stock drops 20%, right? You wait for it to recover. Options expire in 3 days. You can wait just like a stock, sell it, maybe time recover, watch it expire worthless if the stock doesn't recover in time, right? So there's many different ways to be able to answer this, right? Wait just like a stock, not really, but you can, but not really. So that's a probable answer, but it's not the best answer. Sell it, maybe recover some time value, right? This is a good answer, but could it be the best answer? Watch it expire worthless if the stock doesn't recover. I wouldn't do that. So let's just go ahead and sell it to see if we can recover some of our value. Oh, it was C. Look at that. Why? Options expire, stocks don't. If you're wrong about the option, time can kill you, even if you eventually are right. Interesting, fam. So now we're going to go over the Greeks. And then once we go over the Greeks, we'll be Guapater, right? So Greeks are the letters that measure how the options change, right? We have delta, gamma, theta, and vega. So delta is how the option moves when the stock moves $1, right? The gas pedal. The gamma is going to be how fast the delta changes. This is the turbo boost on your gas pedal. Theta, we talked about that before, is how much value you lose per day. This is the melting ice cream. Vega is going to be how much IV changes how much IV changes affects the price, weather sensitivity. And then IV is implied volatility, how crazy the market expects the stock to move. So Greeks are measurements that tells you how your option will behave. Think of it like vital signs. They tell you the health and sensitivity of your option position. So memory trick here is that Greeks equals your option dashboard. So we have the speed. Speed is going to be delta. This is going to tell us, okay, for $1 move, this is how much my option contract is going to go. The acceleration is going to be gamma. Gamma is going to let us know how fast delta is going to move. Our decay is going to be theta, right? Because every single day, minute, hour, second, you're holding that option, it is losing value. And then mood is going to be IV or implied volatility, right? This is how crazy the market expects it to be. So on option pricing machine, right, using Black-Scholes. And Black-Scholes is a way for us to be able to calculate our options just in case we can't get it, right? So if I were you, I'll probably pay attention here. So the ingredients is going to be the stock price. This is how much the piece of cost right now. Then it's going to be the strike price. This is the price that you locked in. This is the price that we want the option to go to, right? The time left is going to be how long until the option expires. Volatility is going to be how crazy the prices are swinging. And then interest rate is going to be what you earn with safe money. So the output is going to be the Greeks. We're going to have delta, the gas pedal. We're going to have gamma, turbo, theta, melting ice cream, or daily decay. Or vega, this is going to be the weather, mood, or volatility sensitivity. So delta is the gas pedal. It measures how much the option moves when the stock moves $1. So the analogy, delta is your gas pedal, but it also is your probability of profit, but more on that in a bit. So delta of 0.05, you press the gas, you go half the speed of the stock, right? That's a good one. Delta of 0.08, you press the gas pedal, you go 80% of the speed of with the stock. Delta of 1.0, you press the gas pedal, it's full speed, you move one-on-one with the stock, right? Now delta also tells us the probability of profit, right? So delta of 0.5 lets us know that we have a 50% chance of this option being able to expire in the money, right? Delta of 0.8 is that we have an 80% chance of the option to be able to expire in the money, and delta of 1.0 is 100% chance, right? You're already in the money, you're already making money. That's super expensive, fam. So a quick guide is in the money is closer to 1.0, right? So you're going full speed, you're going one-on-one, right, with the stock, right? So if the stock is going 100, you're going 100. The stock is going 50, you're going 50, right? So you're matching the speed of the stock. At the money is going to be around 50, so you're going about 50% of the speed. So if the stock is going 80, you're going 40. If the stock is going 60, you're going 30. If the stock is going 40, you're going 20, right? If the stock is going 30, you're going 15. We get it? Beautiful. Now, out the money is closer to 0, right? So if the stock is going 50, you're walking. Yeah. So it can be explosive with this OTM because OTM are normally considered lottery tickets. So it can be explosive, but you just have to know that you're starting way behind the eight ball here, fam. It's going to take a little bit more room in order for us to make our money. And then gamma is going to be the turbo boost. What it measures is how fast delta changes. The analogy is gamma is your turbo boost, right? High gamma equals your gas pedal gets stronger as we go. The stock moves your way, delta increases, and it goes even faster, right? So when you have high gamma and you're already ATM or ITM, bruv, you're going to be printing money, right? So that's why I want to be able to bring gamma into this conversation because I'm not going to hold you like the three options, the three Greeks that and there's like 7 of them. There's Lambda, there's Rho. There's a couple others that we didn't even bring in because I don't use them, right? But I think it's good to be able to understand what they do, right? Primarily when it comes to trading options, I'm looking at delta, gamma, and theta. Sometimes I look at Vega, but not really, right? So stock moves your way, delta increases, and we go even faster. The quick guide is ATM out the money, right? So that's closer to zero point 0.5, has the highest gamma. Gamma is highest near expiration. You're going to see explosive moves here. So 0 DTE is gamma on steroids, huge swings, right? So that's right. When you're right about the what direction and the timing for options, and you picked a 0 DTE with high gamma, bruv, you're printing it. So theta is going to be the melting ice cream. It measures how much value you lose per day. So analogy we already got, it's the melting ice cream. Every day, some of your option melts away. So theta at negative $5 is you lose $5 every day just from time. The closer to expiration, the faster it melts. So ATM options have the highest theta. So that's kind of crazy, right? So ATM has the highest gamma, right? But also has the highest theta, right? You can lose, you can make the most, but you also lose the most. It's great, double-edged sword. It's leverage, right? It's not always about the capital upside, but there's also the consolidation that can happen on you too, right? We have our theta accelerates near expiration. Option buyers hate theta, sellers love it. Remember we talked about that before. And Vega is going to be the weather mood. And what it measures is how much the price changes when IV changes. And IV is implied volatility. This is how much the market expects to the stock to move within the next 30 days, right? So IV go crazy. Vega is going to be like, oh, what's going on? What's happening? Who's there? Who's on my grass? Vega is like that old man, right? Hey, get off my grass. What's going on? Right? When they IV go crazy, Vega go crazy. So analogy is the weather sensitivity. Calm day, low Vega, cheap options. Stormy day, high IV, expensive options. So Vega tells us how much the price swings with the weather. So a live guide, long dated options have higher Vega because you have more time for you. Before earnings, IVs up, options get expensive. And keep this in mind. After earnings, IV gets what? Crushed. Vega gets destroyed in value. So a live look at SPY. SPY is the S&P 500, the top 500 companies within the New York Stock Exchange. The stock price is 681.15. 0 DTE options, right? So we're looking at delta of anywhere between 0.499, theta of 1.0, and then theta gamma of gamma of 0.050, and then theta of negative 1.3, and then Vega, because it's at the money, of 0.06, right? So let's break this down. So just every hour, just by holding this option, we're losing $132 or $1.32 a day, right? Or every hour just by holding it, right? We have a 49% chance, if you want to round up 50, but let's just stick here. 49.9% chance of this option to be able to expire in the money. If this option, for every $1, for every $1 the stock price goes up, this option contract goes up $49, right? And then it's going to get a little $10 boost with gamma as well, right? If we're at 681, right? So this is just one thing to be able to keep in mind. So delta is at 0.60. The stock goes up $2. How much does your option goes up approximately, right? So delta is at 60. Remember, for every $1, I'm making 60, right? So if it goes up $2, so I just doubled it back. I just made 120, right? 120 bucks, right? Just by that $2 move. So approximately we're at 120. I wouldn't be mad if you said C, but that math doesn't. It ain't mathing, bruh. So theta equals negative 15. What happens to your option overnight? It gains $15. I wish, but the math doesn't math that way, fam. You lose $15 just from what? Time decay. Nothing theta works during market hours. I wish. I wouldn't be mad at that answer, right? So which Greek makes 0 DTE so explosive? Is it delta? Is it gamma? Or is it Vega? Right? So we can take Vega out the way because Vega is sensitivity. Vega needs IV, so it's not really. When we're talking about explosiveness, right? This is the acceleration. So this is the gas pedal, right? This is the turbo boost. So just because you hit the gas doesn't mean it's an explosive thing. But if you hit that turbo, it's explosive, right? So gamma is what's going to make it explosive, fam. All right, beautiful. So there we have it. We were able to go through our lesson, and now we properly understand the difference between stock and options, fam. Now, if you do have any questions, if there's anything at all that you're wanting to see a little bit more of, don't be afraid to drop it in the comments. It is your boy Kreative. I'll be back at it again with another episode. And what I need you to do is go ahead and like and subscribe, because if you liked it, maybe somebody else will like it as well. I appreciate y'all, fam. Y'all stay up.